In my 4th year in university, I made friends with an eccentric coursemate. He was quite relaxed about his academics and didn't seem to be as worried about life after school like most of the other final year students were. I later on learned that he had a significant stock portfolio as a 20-something-year-old, which his mom had helped him build since he was age 9. One day he offered to teach me what investing in stocks were all about. He explained that it was simply like trading in any other item. You buy shares when they're cheap and you sell when they're expensive. And that was my first lesson on investing in the stock market. I started investing shortly after graduating, and I got my second lesson from someone I met at my first job. He said that the best time to buy shares was in December, because stock prices always dropped at that time since everyone needed money for the holidays and were therefore selling their shares at lower prices. That was my second lesson in stocks. Fast forward 10 years later, I've picked up other lessons along the way, and I've since developed my own set of principles for investing in the stock market. While I've had to learn from mistakes as well as small wins here and there, I've successfully grown the value of my stocks over that period, and despite the fact that Nigeria just came out of a recession, my portfolio is worth at least 20% more than what I put into it, and that's not counting all the dividends I've cashed in over the years. In this video, I'll be sharing the principles that guide my investment in the stock market and make it easy for me to invest without losing any sleep. And at the end of the video, I'll also be sharing some resources that explain these principles in detail. The same principles that WB has applied in growing his empire, so stay tuned. Before I go on, I'd like to ask you to please subscribe to this channel if you haven't already done so. I'll be making more videos on how to manage and grow your money, and I'm sure you don't want to miss them. So go ahead and make sure to also click on the little bell icon so that you receive notifications immediately new videos come out. Done? Let's get into it. The first principle for investing in stocks is to invest for the long term. When dealing in stocks, some people try to go for the perfect time or the perfect price. Others look out for industry changes, mergers, favorable government policies, and so on. That's all well and good if you're an investment banker. However, for the everyday guy that just wants to buy shares but doesn't have the time or the resources to keep track of every single change in every single industry on the stock market, you need to think long term. What this means is when you buy a stock, you're not looking to buy or sell at the absolute perfect time or price. You realize that over a 10-year period, so long as you've bought shares in the right company, the value will always go up, even if there's a recession within those 10 years. This way, you don't lose sleep or panic over short-term price fluctuations. The market always goes up eventually. How does this influence your behavior in a recession? You buy a lot of shares from good companies, because during a recession, stock prices usually fall and really good companies are priced below their value, meaning you can buy the shares for fantastic companies at really low prices, knowing that in another 2 or 3 years the prices will be back up again. For example, during the global recession in 2009, everyone was dumping their shares in panic and stock prices crashed. I bought Nestle shares at 140 naira per unit at the time. Now that may seem expensive, but considering the stock is currently trading at 1,500 naira per unit 9 years later, I think it was a pretty good buy then. My second principle is just as important as the first, if not more, and that is to choose the right companies. The only way you can successfully invest for the long term is to make sure you bought shares in a company that's still going to be around in 10, 20 or 30 years from now. Once you've identified such a company, you can simply buy a lot of shares and forget about it for the next decade while receiving your annual dividends every year. You're probably thinking that's easier said than done, and you're right. How do I know which companies are the right ones? It's usually not the popular names, and sometimes you'll be surprised at which companies turn out to be perfect to invest in. But like I promised, there's a method to the madness, and you can develop a system that makes choosing the right stocks easy, even for a regular Joe like me. I'll put up a separate video that goes into the details of how I select which companies to invest in, but remember this, it's about the fundamentals and not about nice branding. I once bought shares in a company that had inspiring TV adverts and all the right vision and mission statements. The company collapsed a couple of years after that. Today I have shares in some companies that barely have a website, but each year they make profits and pay me dividends. My investment remains safe and I keep making returns. My third principle took some time to learn, and it's to diversify but moderately. One of those cliches that always gets thrown around when discussing investments is to diversify your portfolio, whatever that means. While it sounds good at face value, I've learned over the years that it's much better to buy as much as you can of a few good stocks than to sprinkle your money all over the place. For instance, let's say we have 100,000 naira to invest in a given month. While the old me will try to play safe and spread the investment over 4 or 5 companies, meaning I only have about 20 to 25,000 naira worth of shares that I can buy in any one company. Today, I'll simply select the best of those 5 companies and invest all of the 100,000 naira in it. I can always come back to the other ones later. If you've applied principle number 2 of investing in the right companies, then go hard when investing with those companies. Why? For one, the dividends are more encouraging. Most people I speak to do not appreciate the value of dividends, and they assume that they only gain from stocks when the prices go up. This is usually because they don't invest enough on any single stock for the dividends to make sense. Imagine you buy a stock at 6 naira a unit and you get dividends of 90 kobo a unit. That's essentially a 15% return on your investment, not counting the potential appreciation of the value of that stock over time. But you wouldn't really notice this if you only bought, say, 2,000 units at 12,000 naira. Your dividends would come to about 1,800 naira, and by the time taxes are deducted, you'll be wondering why bother. Imagine though, if you had invested 10 times that amount, the returns would make much more sense when you see your bank alert. The other reason, like I alluded to earlier, is selecting just a few stocks to invest in forces you to choose carefully and not just speculate. Personally, I target a portfolio of no more than 15 to 20 companies at the very most. That may seem a lot to some, but considering you have to choose from over 150 companies at least on the Nigerian stock market, you're looking for the top best 20 companies you can buy. According to Pareto's 80-20 principle, those companies are usually responsible for 80% of the value generated in the stock market anyway. It takes time to build such a portfolio, but at the end, you know you own the very cream of the crop. The fourth principle is to buy at the right time. I know it's said that investing in the stock market is for the long term, and the right time to buy a good stock is always now. You can save some money and possibly buy more units of that stock if you target the best time to make your purchase. There's really no point buying a stock when it's expensive. Due to the typical habits of professional portfolio investors and traders, stock prices usually go through weekly, monthly, and annual cycles. The principle here is simple. Buy when most people are selling and sell when most people are buying. Why? When everybody else is selling, the prices drop, and prices go up when the demand is high. Within any 1 week, the best time to buy is toward the end of the week, as the prices are usually highest on Mondays and lowest on Fridays. Also, as traders tend to sell towards the end of the month, the best time in a month is always the end of that month. In short, the principle for buying shares is buy at the end of a week, a month, or even a year, because investors usually recoup towards the end of a cycle. And like we talked on, portfolio investors usually recoup annual investments towards the end of the year. Plus, more individuals are selling. Everyone needs money for Christmas, so you always get good stocks at low prices. Here's a pro tip. Sometimes I wait till the end of a month to make a purchase, even though I've already decided on a good stock to buy. This allows me some more time to pull enough funds together so that I can buy as much as possible of a great stock at a lower price. Before we go, I have a bonus tip for you. Tip number 5, commit to learning. I started my journey into the stock market over 10 years ago, and you can bet that my approach 10 years ago is way different from the way I buy shares today. I've learned a lot over the years. I've adjusted my investment habits as I learned, and I continue to learn every day, even now. I'll be sharing more of what I've learned in subsequent videos, so once again, don't forget to subscribe. But remember, there are no shortcuts to this. To pick the right stocks, you need to check the fundamentals. A lot of the principles I apply to investing in stocks, I learned from applying lessons from 2 books. The first of which was written by Warren Buffett's mentor, Benjamin Graham. And the title of the book is The Intelligent Investor. It contains fundamental principles for value investing, some of which I've already highlighted in this recording. The second book is actually a collection of great nuggets from 50 books on making money. It's titled 50 Prosperity Classics by Butler-Bowdon. It's a classic in itself, and it provides quick summaries of the best 50 books on money. I can't recommend these 2 books enough. I'll leave links to both of them in the description. Here's a pro tip. If you're like me and you prefer to listen to books while doing other things like driving or exercising, you can get the audio versions of these books on Audible. But if you're like a lot of my friends, you could still get the paperback on Amazon as well. So those were my best tips for buying shares or investing in the stock market. Just before you go though, do me a favor. Mention one new thing you learned from this video in the comments below and what you plan to do about it. Also, don't forget to share the video with someone that you feel needs it. Have a lovely day, and remember, it's not the size of your paycheck, it's how you use the money.